The precious metals market has entered one of the most volatile and historically significant phases in modern financial history. Gold and silver prices have experienced movements that have not been recorded for decades. Silver recently crossed above $100 per ounce and gold has tested levels near $5,100. These price levels reflect structural changes in global supply, demand, and monetary policy rather than short-term speculation alone. The scale of volatility indicates that the market is undergoing a transition driven by physical shortages, geopolitical shifts, and declining confidence in fiat currencies. One of the most unusual developments is the presence of backwardation in both the United States and Chinese silver markets. Backwardation occurs when the spot price of a commodity is higher than its futures price, which is rare in precious metals. In the U.S. market, silver spot prices exceeded futures contracts, indicating immediate physical demand. A similar condition appeared on the Shanghai Gold Exchange and Shanghai Futures Exchange. Physical silver in China closed near $128.48 per ounce, while U.S. spot silver traded near $106 per ounce. This created a premium of approximately $22 per ounce for silver in China compared to the United States. Such a premium signals strong demand for immediate delivery and potential stress in global supply chains. Market volatility reached an extreme level during a single trading session when silver moved approximately 15% within hours. This type of movement is statistically described as a 5 sigma event, meaning it is expected to occur only once every 13,000 to 14,000 years under normal market conditions. During that same trading window, silver's total market capitalization fluctuated by nearly $2 trillion within a 14-hour period. Silver gained around $500 billion in market value, then lost approximately $950 billion, and later recovered another $500 billion. This scale of movement is comparable to the entire market capitalization of Bitcoin changing hands in a single day. Paper trading volumes further highlight the imbalance between financial contracts and physical supply. In one session, approximately 1.8 billion paper ounces of silver were traded. This volume equals more than 2 years of global mining production in a single day. Such activity demonstrates that futures and derivative markets are heavily leveraged relative to the amount of real physical silver available for delivery. Estimates suggest leverage ratios between 300 to 400 paper ounces for every 1 ounce of physical silver in storage. China has become a dominant force in determining the true price of silver through its physical exchange system. Unlike Western markets, the Shanghai Gold Exchange requires physical metal for settlement. Recent data showed that Chinese vault inventories declined by roughly 29,000 kilograms while prices remained significantly higher than U.S. markets. This reflects ongoing accumulation by China and possibly India as well. These countries continue to absorb large portions of global silver supply, supported by industrial demand from solar energy, electronics, artificial intelligence data centers, and defense technologies. Global mining supply presents another major constraint. Peak global silver production occurred in 2016. Since then, worldwide output has declined and is not expected to recover meaningfully until at least 2030. Only about 30% of silver production comes from primary silver mines, while the rest is a byproduct of mining copper, zinc, and lead. New silver mining projects require long development cycles, regulatory approvals, and capital investment. Experts estimate that there are not enough projects in the pipeline to significantly increase supply over the next 4 to 5 years. This supply shortage is occurring at the same time as demand accelerates. Industrial demand continues to rise due to solar panels, electric vehicles, military equipment, and semiconductor manufacturing. Retail demand remains strong in Asia, particularly in China, India, and Singapore. Bullion dealers in Singapore reported record customer traffic and transactions at all-time high prices. Online bullion dealers globally have reported shipping delays and inventory shortages, suggesting stress in physical distribution networks. The silver-to-gold ratio also reflects undervaluation of silver. In recent years, the ratio exceeded 85 to 1, meaning it took 85 ounces of silver to buy 1 ounce of gold. Historically, when this ratio reaches such extremes, silver has delivered gains of up to 300 to 400% in subsequent cycles. Current prices suggest silver is undergoing a structural revaluation rather than a temporary spike. Government involvement is becoming increasingly important. Reports indicate that U.S. policymakers are considering rebuilding a strategic silver stockpile. This would be the first major silver reserve accumulation in decades. A proposed $2.5 billion critical mineral reserve highlights recognition of silver's strategic importance for national security, defense manufacturing, and energy infrastructure. However, this amount is small compared to daily interest payments on U.S. debt, which exceed $2.5 billion per day. Monetary policy remains a powerful influence. Federal Reserve data shows a 97% probability that interest rates will remain unchanged in the next meeting, with only a small chance of rate cuts. Market expectations suggest that rates are unlikely to rise further and that future cuts are more likely than hikes. Historically, precious metals perform strongly in environments of stable or declining interest rates, especially when inflation remains elevated. The U.S. dollar index, DXY, remains near 96, which is historically high given current gold and silver prices. During the period from 2001 to 2011, silver rose from under $5 to nearly $50 while the dollar index fell sharply. This historical relationship suggests that if the dollar weakens further over the coming years, precious metals could experience another major upward cycle. Market capitalization comparisons further demonstrate the scale of change. Gold's total market value recently surpassed $35 trillion, while silver reached approximately $6 trillion. Combined, gold and silver now exceed the market capitalization of many of the largest technology companies, including Nvidia. Institutional investors, hedge funds, and sovereign wealth funds monitor these rankings closely as part of asset allocation decisions. Interest in precious metals is spreading beyond traditional investor circles. Financial analysts with millions of followers on social media have begun discussing gold and silver price movements. Conferences focused on cryptocurrency have reported increased attention on silver as an alternative hard asset. This crossover suggests that silver is becoming part of a broader movement away from fiat-based systems and toward tangible stores of value. Long-term price projections vary widely. Some analysts project silver reaching $200 per ounce by 2026 based on industrial demand and declining mine supply. Other forecasts suggest potential levels between $500 and $750 per ounce by the end of the decade if structural shortages persist and government stockpiling accelerates. Gold projections include targets near $27,000 per ounce if global currencies undergo significant devaluation, or if gold is revalued as part of monetary restructuring. The key factor that historically resolves imbalances in precious metals markets is price itself. Higher prices encourage mining investment, reduce speculative paper leverage, and ration demand. Paper markets can distort price temporarily, but physical shortages ultimately force repricing. Throughout history, gold and silver have adjusted upward during periods of monetary stress, geopolitical conflict, and declining trust in financial systems. The current environment combines multiple supportive conditions: constrained supply, rising industrial demand, strategic government interest, high leverage in paper markets, and shifting monetary expectations. These elements together suggest that recent volatility is not random but part of a larger revaluation process underway in precious metals. Rather than representing a speculative bubble, current price movements reflect fundamental pressures within global supply chains and financial structures. The widening premium between Chinese and Western silver prices, the decline in mining output since 2016, and the unprecedented trading volumes in futures markets all point toward a transition phase for silver and gold. If interest rates stabilize or decline, if the dollar weakens further, and if governments expand strategic reserves, precious metals may continue to attract capital flows from both retail and institutional investors. The historical role of silver as both an industrial metal and a monetary asset positions it uniquely in the modern economy, where technology and financial uncertainty intersect. In conclusion, the precious metals market is experiencing a rare convergence of forces that have not appeared together in decades. Extreme volatility, physical shortages, government interest, and monetary uncertainty are reshaping price discovery. Whether silver reaches $200, $500, or higher will depend on how quickly supply can respond to demand and how global financial systems evolve. What is clear is that silver and gold have re-entered the center of global economic attention, not as speculative instruments, but as strategic assets in an increasingly unstable monetary landscape.